Morning, Market Chameleons. Happy Monday. Dimitri Pargamonic. How you doing, buddy?
Good morning, Will. How are you?
Excellent. Great webinar last night with Felix Frey, huh?
Yep. Yeah, I always enjoy having him on. He's very animated, he makes it interesting.
Yeah, and he's got a real interesting background. It's always good. Let's start with the disclaimer. What do you think?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're not giving you any kind of investment advice. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions and provide you with guidance. There's disclaimer.
Excellent. So what are you thinking on guiding us through today?
I think we'll just take a look quickly today, what's going on in pre-market hours, and then we'll come back to earnings, see what's coming up on the earnings front. We haven't done that in a little while. And if there are any questions along the way, I'll answer as many questions as I can, because we have been getting a lot of questions lately. So I'm going to just try to concentrate on that. So here we have pre-market. This is the pre-market report. Stocks trading in a pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. I'm going to just take a look how many made our percentage gainers list. So we see 61 stocks made our percentage gainers list in the pre-market hours, 91 on the percentage decliners list. So from that perspective, it looks like a more bearish bias at the open. Now I'm going to just flip to higher market cap stocks and see what's going on there. So I'm going to use this market cap filter, stocks 20 billion or higher, and we see 5 on a percentage gainers list, 27 on a percentage decliners list. So from that perspective, again, more bearish bias at the open. I'm just kind of scanning with my eyes. The one that sticks out right now is AT&T. That is trading 4.5 million shares in the pre-market. These other ones, not as much. Viacom, almost 1 million shares. So I think AT&T is spinning off their entertainment business, I believe, to Disney. Is that correct, Will? Have you read anything about it?
I haven't, but I did see on CNBC this morning they were talking about it.
Yeah. So it looks like they're going to be spinning, and I think that AT&T was looking to sell some of their assets. I think, a lot of people don't know AT&T is also in the entertainment business, not just like cell phone, but they own actual, I think they own CNN, don't they?
They have a lot of different assets. It's incredible.
They have a lot of different assets. So we'll take a look, but up 2% on that news in the pre-market hours. Other ones that just kind of stick, Coinbase, I'm seeing trading right now 249. I think that their original IPO reference price was like 250, but they actually opened like $380, right? Well,
yeah, no,
it's anywhere close to 250. Open 380. I think there's so much enthusiasm right from the start that sometimes that opening price is just very optimistic, coming back down. So right now 249, that was right next to the original reference price of 250. So we'll see how that goes. And of course,
and anyone interested in the crypto space, that was like, I don't know, the strongest, biggest play to come onto an equity market that there is. It's such a used platform for anyone who's involved in the cryptocurrency trading, holding capital as coins. It's an interesting company. I don't know about the valuation, but
yeah, and you could see like we were talking about their valuation when they went public. I'm not sure if it's still the same case, but their valuation was higher than CBOE, higher than NASDAQ, which they listed on. I think higher than maybe the NYSE. So there, and it's an interesting model because Coinbase, it acts like an exchange, kind of like they list different cryptocurrencies that they're market makers and prices on the exchange, and you could go and buy and sell. But at the same time, you could open an account and buy directly through them. So they're acting, as where we have an exchange like the NASDAQ or CBOE or NYSE, but to access that exchange, you have to go through a broker, an intermediary to get to the exchange, right? So you're not going directly to the exchange yourself, you're going through your broker. Now, the way these exchanges are structured is you actually have the account directly on the exchange. So everybody kind of is, at least they're maybe equal footing to get direct access to that exchange. But we'll see. And a lot of people say eventually all securities will become digitized, right? Become a digital asset and maybe perhaps trade that way on a blockchain technology. But let's move on. If there are no questions on the pre-market report, Will, I'm going to move on to the upcoming earnings.
Yeah, actually, Robert just said he obviously read deep into the AT&T. He says it's forming a joint company with Discovery Network. So I know Discovery Network has been pushing their streaming package for a while all over cable. So
Okay.
AT&T is getting somewhere between 40 and 50 billion to reduce debt as part of this deal. So
okay.
yeah.
So it's more like a strategic alliance, not like not a sale, but it's like a strategic.
Well, it's actually a company. They're forming I guess a company that then they could potentially roll into the market. I mean, it's interesting. Maybe everyone should probably read more into it to see, as Felix was saying last night, right? There are all these levels of research you should do before you act on a trade. Just because it's up 2% this morning, which doesn't mean
you can't like just the price itself be the driver of your decision. You should go do that research. What's behind the trade? What's the catalyst to drive it either higher or the catalyst to drive it lower? That's what Felix was kind of talking about yesterday. So you got to go. This might be an initial way to find trade ideas, right? Either price activity or news, and then you have to go do more research to see, well, what's the catalyst behind driving the stock higher from here or the other way lower. So I'm going to move on. Well, it sounds like any questions on this? All right, so let's take a look at what's coming up on the earnings front. So let's go up. Actually, I just noted Tesla also down 1.8%, down to 579. And that's been kind of having a tough time lately too, right? That since they peaked, what was their high? Let me just take a look real quick.
I mean, it almost touched 1,000. Maybe it did touch.
It was up there, so I'm just looking right now. Tesla closed 589.74, 577.80 in pre-market, but we see here the high of 900, low of 157, so huge range. And that's been having a tough time. And I remember when was that guy who started shorting Tesla saying it's just valuation's too high? That from
I don't know, but a lot of people were saying a lot of people were saying the valuation was too high when it was 150. So
that's true. It's true. Yeah,
a lot
can't
of
underestimate.
Had their faces ripped off.
Yeah,
but I mean, at the same time, when the stock was at 900, Kathy Woods, and there are a lot of real strong bulls, and they were saying Tesla could be a $4,000 stock.
Yeah, you could make a strong case, for if you look at it as an energy company, innovative store, a way of producing and storing energy, but at least right now 577.80, so cooled down. We're not seeing like those big rallies as we used to. Let's go to upcoming earnings. And I think what's interesting, we're looking at what do we have coming up, like Home Depot, Walmart, Target, Lowe's, all kind of similar companies selling. We might get some indication about inflation coming out from these companies, because we'll see if they say anything about that, if there's pressure on prices, because on prices that they're paying, right, that they might have to raise their prices on their customers. So if they're experiencing pricing pressure, just like what do we see, like Kimberly-Clark, Procter & Gamble announced they're raising prices, Warren Buffett said he's seen tremendous pricing inflation. So let's see what they say, if they give us any more insight on that as well, because I think that's where people right now are concentrating. What's going on with inflation? Are we actually seeing like the beginning of a much bigger move in prices and inflation going forward? So I think it'll be interesting to see if they start talking about that. So right now we're on an upcoming earnings analysis. I'm going to start filtering out some stocks here based on liquidity. So I'm going to look for stocks with option volume of 5,000 contracts or more per day on average. So I'm using this filter, and let's go to the full report next 2 weeks. So these are stocks that meet this criteria on the filter, and we have a list of stocks expected to report earnings in the next 2 weeks. These are the symbols. This is the average option volume per day. These are the dates of the earnings releases. Next to it, we have the implied move. So if you're looking at it for the first time, what's the implied move? If you're buying, these are looking at option prices. If you're buying a call and buying a put at the money, you're paying premium, and you're looking, and this is looking for a move either up or down. So remember, you're trading options, you're looking at volatility, and when you own the straddle, you're paying premium for both options. So you need the stock to move by a big enough percentage to cover the cost of that straddle, either to the upside or to the downside. Okay, so that's what the implied move is over here. And these are the break evens, right? So XL, that's expected to report tonight after the market close. That straddle is implying a move of 16.3%. So how does that, so we have a couple questions here. How does that measure up to historically, how the stock actually moved after reporting earnings? So how does that compare to historical realized moves? And also we might take a look at how does this straddle compare to historically how the straddles were priced prior to earnings. Okay, so up here, let's first compare it to the historical average moves. So here, we take a look at the last 4 quarters. So if we take on average how much the stock moved in the last 12 quarters, and you know what, I'm looking at this Excel. I think this is a relatively new stock. So I'm going to skip to something with a higher history. So this to me looks like, just looking at these numbers, it looks like there's not a long history of earnings. So I'm going to just kind of go down to something else. Let's go to the next highest volume, TME. So TME trades 40,921 contracts on average per day. That's expected to report today after the market close. That straddle right now implying a move of 8.8% in either direction. So how does that compare to the historical realized moves? We see in the last 4 quarters, on average, the stock moved 2.1%. You know, that's the magnitude of the move. It doesn't matter up or down. That's the average move after reporting earnings. The last 12 quarters, the average move was 4.3%. So we could see that right now the straddle is priced 6.7% above that 4-quarter average and 4.5% above the 12-quarter average. Okay, the high move the stock made after reporting earnings in the last 12 quarters was 10.3%, which would be, you know, above the current implied move. How does the 8.8% compare to the historical straddles? So these aren't the realized moves, but historically, where were the straddles priced heading into earnings? So we see it was on average 9.4%. Let's take a look at which one do we say? Walmart?
Yep.
Okay. So Walmart here, that's expected to report tomorrow before the market opens. So now the straddle, as of Friday's close, right? It's Monday. We're not open yet in the market. Friday's close. that straddle is implying a move of 4%. How does that compare to the historical realized moves? So if we use 4-quarter as our benchmark, on average, the stock moved 2.8% after reporting earnings. 12-quarter, the average is 3%. So we see we're 1.2% above the 4-quarter average, 1% above the 12-quarter average. The high move on that stock, 9.3% in the last 12 quarters after reporting earnings. And we could see here 4%, that's kind of in line where it's usually priced heading into earnings. Low, that's the 19th, so not tomorrow, the day after tomorrow, before the market opens. You could see it trades 18,600 contracts on average per day. That straddle is implying a move of 5.3%. That compares to a 4-quarter average move of 3.1% and a 12-quarter average move of 5.6%. So we're 2.2% above that 4-quarter average, kind of in line, a little bit below the 12-quarter average move. The high move on that stock, 11.8% in the last 12 quarters, and 5.3%. That's a little bit higher than where it was on average in the last 4 quarters, and a little bit below the 12-quarter average. So those options look like they're priced kind of like in the middle where they're usually at. Home Depot, I missed that one. I didn't talk about Home Depot, or did I?
No, but it is interesting that, I mean, I guess they choose to do it that way, where Home Depot and Lowe's are like back to back, right? I mean, they're
sometimes, yeah, you see similar stocks report very close to each other. Like the banking stocks usually report very close to each other, right? Like almost back to back, sometimes on the same day,
yeah.
but not that far apart. So Home Depot, Lowe, very close to each other, although you got
all these retailers. You have TJX, I think that's TJ Maxx. I mean, there's so many retailers reporting these next 2 days. It's like it's exactly like the banks. Actually, the banks kick off the earnings season, and this is like halfway or maybe towards the end of the earnings season almost.
Almost like they're doing it on purpose. They watch each other. So Home Depot, that's going to be tomorrow before the market opens. That straddle as of Friday's close, implying move 3.6%. The historical 4-quarter average realized move on average 2.4%, 12-quarter average move 2%. So we could see 1.2% above the 4-quarter average, 1.6% above the 12-quarter average. The high move on Home Depot, 5.4% in the last 12 quarters. And we could see that straddle kind of priced close to where it has been historically. 3.9% in the last 4 quarters, 3.7% in the last 12 quarters. So I could go. Are there any questions on the earnings, Will?
We haven't had any, no.
All right. I could just pick one of these and kind of go into further analysis. So
I'd love to see it. I personally would love to see a comparison of Home Depot and Lowe's. I don't know if you can do that with the fundamentals, but whatever you want to do.
Okay. Well, let's take a look at first Home Depot.
All right.
But what did you mean? Like just look at their fundamentals?
Well, I love, when you look at them against each other. I mean, it's just so interesting they're the same day. I mean, let's look at what the straddle's saying and what the options are doing for sure. But I'm just thinking in my head about the fundamental features you've put in place, and I'm wondering how they look relative to each other. That just popped into my head. You do not have to do that, but that was something that popped into my head.
Okay, we'll take a look if I have time.
All right, cool.
So Home Depot here, we're going to take a look first at the historicals, how the stock moved relative where the options were implying. So these bars over here, we see we start at 0. The up and down bars are telling us what the straddle was implying to move up or down. That's why you're seeing the bar going both ways, right? So it had to move beyond this bracket to in either direction if you're along that straddle. So in this example, I'm going to hover over February 23rd before the market opens. Home Depot reported earnings. the stock was down 3.1%. That day, the straddle day before was implied move of 3.4%. So you could see that move was close to where the market was predicting, but a little bit less. When we see something like this punch through the bracket, so this is to the upside, August 20th, 2019, before the market opened. Home Depot reported earnings. That day, they were up 4.4%. The day prior to that, that straddle was implying a move of 3.4% in either direction. So you could see that that move exceeded what the straddle was implying, right? So if you sold that straddle, you would have to buy back higher, resulting in a loss. If you bought that straddle, it would have been profitable because that move exceeded what the cost of that premium, the straddle. So that's how you're looking at this. It looks like a lot of times after reporting earnings, they've been down. But let's see the longer term statistics. So in the last 12 quarters, 83% of the time, the straddle overestimated the move. In other words, that straddle was pricing in the move above where the actual move was. So the straddle heading into earnings on average implied a move of 3.7% in either direction versus the historical realized move of 2%. So we can see there's about a 1.7% differential between the implied and realized. Okay. And here you could see how the straddles performed. So if you're long the straddle, that was profitable only 18% of the time in the last 12 quarters. If you did this straddle from the long side, on average, your average return was minus 18%. Okay. So obviously from the short side, historically, it was better. That's why Credit Iron Butterfly, that was a winner 73% of the time for an average return of 32%. Credit Iron Condor, that was a winner 82% of the time for an average return of 15%. Let's take a look at if there are no questions here, I'm going to move over to the implied volatility.
Cool.
So when we look at the IV crush, we looked at the straddles initially just now, and the straddles, the very near-term options prior to earnings, they mostly have gamma, right? So they're pricing in mostly the move because they have less time decay after the move. But as you go out further and further in time, you have more vega in the options. So the vega in the options are higher. So we're going to look at an option that has a 30-day constant maturity. So this is 30 days to maturity. Okay. And here we see that option day after reporting earnings, on average, the implied volatility declined by 16%. So average IV, 30 IV day before earnings, 25.4. The implied volatility the day after reporting earnings, on average, fell to 21.5. 5 days later, 21.2. So you could see here the decline. So today we're at 24.4, a little bit below that average. Okay. So when you're looking at that 30 days out and you got the near-term options, this is where people use the calendar spreads, right? They're using the calendar spreads to spread off the risk between the near-term option, where you're getting the move, and the longer-term option, where you're getting the move and the vega, right? So here we see, what do we see here? A calendar spread selling the near-term, so that's selling the expiration at the money call. That's the nearest expiration that straddles the earnings, that covers the earnings, and buying the further out option, which is at least 2 weeks out or more. That was a winner 64% of the time for an average return of 21%. All right, same thing, put spread, selling at the money near, buying far, 73% of the time winner, average return 19%. The diagonal, so this one is buying the near, buying that at the money near, selling that out of the money far. So you're doing almost like, think of it as like buying a call spread, except the leg that you're buying, that the money is in the near term expiration, and the out of the money call that you're selling is the further out expiration. So that was a winner 10% of the time for an average loss of 32%. So obviously if you're doing the reverse of that, that would have been a winner 90% of the time for an average return 32%. Okay, everybody understand that?
Yep.
Same
No
thing.
questions about that. Seems like they're good.
Right? Diagonal spread in the puts, buying at the money option put in the near term, selling a downside put that's out of the money in the further out expiration. That was a winner 55% of the time, but an average loss of 5%. So those are the historical stats. Let's see how Home Depot tended to do around earnings. So I'm going to take a look at how the stock behaved around earnings. So we have stock behavior heading into earnings, day of, and afterwards. So see, before earnings, looks to me like the stock, tended to run up more often than down, not very strongly, but, maybe 2 weeks heading into it, 67% of the time stock was higher heading into earnings, looking at a 2-week period for an average gain of 2.4%, kind of 50-50 as we get closer. After reporting earnings, stock tended to gap down lower more often than higher for an average loss of 0.9% on average. These are the data points for each of the different earnings. Okay, this is the summary. The average move at the open. So we see if we take these gap moves and convert them all to positive to look at the average move, 2% up or down. What did the stock tend to do after the opening? So we see here the stock gapped up or down, right? Then we use the opening price as our new reference point. What did it tend to do the rest of the day? So we see from the opening price to the high of the day, the average move up 1.1%. From the open to the low of the day, average move down 1.9%. So from this perspective, it looks like we got kind of 2-week numbers. Not only did it tend to open lower more often, but during the day, the magnitude of the down moves exceeded the magnitude of the up moves. Okay, 1.9% to 1.1. Drift open to close. So we use the opening price. What did it do from the opening price to the closing price? 58% of the time lower, 42% of the time higher, for an average loss of 0.3%. Again, these are just historical statistics. You still have to pay attention to what they say, during their earnings. What they say matters. What they say about going forward matters. You have to pay attention to the report itself as well. But this is how it tended to behave after reporting earnings. And it looked like maybe heading out of earnings the next couple of days, the stock was weaker. So that's Home Depot. Let's take a look. Since we brought it up, we only have kind of 2 minutes. I'm just going to take a look at the fair value really quickly. So this is looking at where would Home Depot be priced if we used historical multiples. In other words, if we use the average PE that it traded at the last 3 years, average price to sales, average price to operating income, so we get an implied value. Then if we did the same thing and said, what is its PE relative to the rest of the market? So if on average it traded at a 32% discount, on average it's traded at a 15% discount. Right now it's at a 32% discount. What is its implied value? So if we ran through this model and then took the average of these implieds, we get an implied value of 320.98. Right now we're 323.63, so kind of in line. So it's neither, I would say like right where its historical multiples were. 1 minute left. I'm going to look at this comparative model. This is looking at forward-looking growth rates. So if we compared, I don't think I have enough time to go through this one. So maybe,
Yeah, we can
tomorrow.
carry that through to tomorrow. What do you think?
Yeah. But we're right at 9:30. So,
Another awesome job, D. You bring it every day. Thanks so much, buddy.
all right. Thanks, everyone. Stay safe out there. Have a great trading day. Thank you for joining. Hope to see you guys tomorrow.
Trade in peace, chameleons. Thanks, everybody.